Well, welcome everybody to Monthly Market Insights. Today we've got some good questions that we've been kind of hearing from clients, things that we're doing. And today we're also going to kind of talk about market performance year to date, how all those things are doing, and how we did coming out of the recession from coronavirus and through the election and all that. So with that being said, I'll let Nora take it from here.
Sean, so actually I mentioned—
Can't hear you, Nora.
Oh, can't hear us, me? Let's see. Can you hear me now?
No.
Let's
Oh, he can hear. It's got to be muted.
Yeah.
User error.
Panelist. Okay. So I'll just kind of ask the first kind of topic that's coming up in a lot of conversations as we are wrapping up second quarterly meeting with clients, things that they're talking about, things we're hearing a lot about. It's probably on your mind. It's probably on everyone's mind. So hopefully you're not tired of hearing about it, but it's inflation. And there is a big economic data point that's coming out on Thursday in the Consumer Price Index. And so, Sean, can you talk to us a little bit about what inflation means for investors' portfolios, some things that we're recommending for clients in terms of what to do with cash and how inflation may impact that?
Sorry, I was my sound wasn't working. I messed up.
Can you hear me now, Sean?
Yeah, you know. Yep.
So I just kind of posed the first topic that I know we want to address because it's coming up a lot in conversations with clients. The second quarter is inflation. Talked about a big economic data point in the Consumer Price Index coming out this week. So tell us, Sean, what does that mean? What does inflation mean for investors' portfolios? What are some things that we're recommending to keep in mind for, let's say, cash that's maybe sitting around, or how that impacts their investing choices?
Yeah, absolutely. So I'm going to share my screen. Let me know if you're able to see this. Are you guys able to see that?
Yeah, all good, Sean.
All right, great. So we are seeing lots of inflation. So this is from the Bureau of Labor Statistics. And as Nora said, we're getting another data point on Thursday to see how we've been doing over the last 12 months through May. So that will be a great data point for us to kind of gauge how things are doing. But since last April, if we go to April, kind of the 12-month rolling average for inflation is 4.2%. Right, and you can see some of the areas that have extreme inflation, things like energy. We like to call that cost growth, right? So inflation is the general rise in the price of all goods. And then on top of that, we'll also have some cost growth. So things that may be growing more than just inflation, that would be the cost growth portion. So we see energy, food being a little bit lower, but we've got lots of different types of inflation happening in the economy. So what does that mean for your portfolio? And what are some things that are good places to invest, maybe not so good places to invest during times of inflation? So one of the key things I'd like to point out is one of the tools that the Fed has in order to combat inflation is to raise the price in interest rates. And so the Fed, really since 2008, has done a quantitative easing, if you will, to keep interest rates really, really low. That's why it's really cheap to borrow money right now. If you go buy a mortgage, we've seen clients within the last 6 months get 30-year refinancing their houses for less than 2.5%. I mean, just insane numbers. And still today, it's around 3%. So what that means is as the Fed tries to raise the interest rates to keep inflation down, to make it harder for people to borrow money so that there's not as much money in the system, we could see that people stop spending as much money. Businesses stop spending as much money because it's more expensive to borrow money. Additionally, labor costs tend to go up. Also materials, right? For anyone that knows someone trying to build a house right now, we've seen things like lumber up more than 300% over the last 12 months. So it's more and more and more expensive to buy materials, to hire people, and therefore companies don't make as much profit. So stocks don't tend to do great during periods of high inflation due to the increased cost to borrow money and then the increased cost of materials and labor, right? So what are some areas that tend to do pretty well during periods of high inflation? Things like real estate. we've got clients in almost all 50 states, and we've got clients all over the country, and every one of them are telling us the price of my home is just going through the roof. Everyone is having a ton of equity put into their homes just naturally through inflation, because it's cost more and more and more to buy a home because of low interest rates, because there was so much money put into the system. And so when that happens, people were getting stimulus checks, people were getting PPP loans for small businesses. They had lots and lots of cash, and they were paying down debt, and they were, kind of paying off some of the other bills that they had outstanding and saving a lot of money, because during recessions, people tend to save more because they get a little more scared. So now that we come out of those recessions, people start spending money. And if you just gave everyone $1 million, I heard an economist say this recently, that doesn't make everyone a millionaire, because then that doesn't mean everyone go out and buy a Ferrari, because there's just not enough Ferraris out there. So the price of a Ferrari is going to increase so that the same amount of people can buy Ferraris. So as we push all of this money into the system, we see inflation rise. People start to have more cash to buy things. They start buying things. And eventually, to cool it down, the Fed raises the interest rates and businesses have a harder time borrowing money. So those are some of the things we're seeing with inflation. So what are actions that clients can take, and what things that we've been kind of pushing really for like the last 12 months? We've been talking about all of the extra stimulus that's being put in the economy. Inflation's coming, right? We were talking about kind of a post-World War II type of economy. The last time we saw this much spending in the government. We've been talking about this for 12 months, and we're starting to see it actually happen. And so what we don't want to do is we don't want to sit on a lot of cash. So anybody that has a lot of cash sitting around, that's not going to be good for their portfolio, because in this example right here of the last 12 months, you've lost 4%. Meaning, if you had $200,000 to put towards a down payment on a $400,000 house, you were only going to have to borrow 50%. Well, now that house costs $500,000, so you put your $200,000, and you have to borrow more. What we want you to do is we want that cash to work for you, so that when you go to buy that house, or you go to buy whatever the good is that you're looking for, that your cash has grown at the same rate as inflation. So we like to keep the money extremely conservative in a safe portfolio, but we want it to be earning at least an inflation amount, hopefully a little bit more, so that you're not losing 4% over a rolling 12-month period. So those are great actions that people can take. Things that tend to do really well, again, real estate, commodities. So we'll kind of talk about how we have those in the portfolio, and we'll show you some real data. Also banks, right? When banks tend to raise interest rates, that means they start to make a little bit more money as they do place loans. They won't be making as many loans, but they'll be making a higher margin on the ones that they do right. So those are a lot of the areas that tend to do well during these high periods of inflation. And we'll talk about our asset classes in our portfolio and the value there.
Yeah, Sean. So kind of our next topic that's coming up in conversations during these meetings with our clients is, one, we have to give credit to a lot of investors that have just stayed disciplined, stayed informed, didn't make any irrational choices, didn't really play into the fear that media has. Talk to us, Sean. I know we've been through a lot the past 2 years with the election, coronavirus, meme stocks, what Elon Musk, his next tweet, whatever it may be. The investors that stayed disciplined and invested. Show us, Sean, kind of maybe break that down by asset class, year-to-date performance. You kind of alluded to it with the real estate, but just kind of walk us through how things have been performing.
Yeah, so I'll kind of address the first topic. Since the market kind of hit rock bottom during the coronavirus recession, was about the middle of March. And so these are kind of our portfolios. I always like to say past performance is not indicative of future results, right? So don't go thinking that. But since that market low, for the people that had the discipline, and I think it's very important to note that our clients, we didn't have a single client call and run to cash. They didn't stop contributing. We were educating through things like this monthly market insights. Stay disciplined. The market will come back quicker than you think. And if we take that approach, you'll do well. And here's exactly how the markets have done since that bottom. And so we look at certain asset classes, and that's kind of how we'll be talking about these, which are kind of labeled here at the bottom of this graph. And so we see that the best performer is small value, right? It's up almost 70% since that market low. So for people that sold, they missed out on all of this rise in the market. Other things that have done really well, the NASDAQ index, we've got the S&P 500. We've got international small, again, kind of like small value US. International has done really well as well. So have emerging markets. The thing that it'll be really interesting is we're going to go over year-to-date numbers, but real estate still has done really well, right? Almost 30% since that market low. But we had a lot of discussion and a lot of talk and a lot of concern about, will commercial real estate ever come back? We've all gotten so used to Zoom. Will people come back to work? Will they always be working from home? How will all that play out? Well, we all start to see office buildings, go under because everyone's working from home. And so when you get the rise in the prices of goods, like you get something like inflation, homes also go up, but also people are going back to work. We're seeing companies start to say, yeah, we know that you're kind of hanging out at home, maybe not being as productive. Plus, we just want to see your face. We want to have a little bit more control. So more and more people are coming back to the office already. So we're starting to see real estate come back. But you can see kind of over that little bit more than 14 months now since that market low, the people that stayed disciplined, that stayed in the portfolio, because they knew where their money was invested and why it was invested, they stayed there and they reaped the reward for it, right? And so that is the benefit of having all that diversification in the portfolio. We don't know which asset classes are going to do great from one time period to the next, but we know if we own all of them, that we're going to drastically reduce our risk and we're going to be there for when the market does come back. And so that's exactly what happened. Kind of year to date. So this is now 1 January through 4 June. Some of the asset classes that have been outperforming, S&P is up over 12% already for the year. If you'd have told me that, at the beginning of the year, through the election cycle with the coronavirus going on, that the S&P 500 through a 5 months period already would be up over 12%, I don't know that I would have believed you. I thought this year would be a little bit more volatile. But again, that's why we don't try and time the market or guess, because no one really knows. And so someone that does tell you that they know, they're really just lying to you. Best strategy is diversify your portfolio and stay invested. So again, small value has been the best performer year to date, up over almost 25%. We're unique in our portfolios because we have a tilt towards small value. And the reason is because there's Nobel Prize in the research that says you should. But most people don't have this in their portfolios, not in their 401k. It's just not the way that most people invest. They tend to buy companies that they know, the Home Depots, the Googles, the Coca-Colas, things like that. Having that small value in there in times out of recession tend to do really well. The other thing that I think is very, very interesting is real estate. It's kind of the second best performing asset class year to date. And again, I think that's because we saw that more commercial real estate is tending to do a lot better. And then anyone that sold or bought a home recently just knows how quickly and how hot the market is. People are overpaying for homes. And we're starting to see all of that be reflected in the real estate market as we see some of this inflation play out. NASDAQ has kind of been one of the losers. So it did really well coming out of the pandemic. And it really has had a really good run over the last several years with all the technology. And we saw things like companies like Zoom and Peloton and some of these other companies, these stay-at-home companies, do really, really well last year, even though the market may not have been doing well, because they found a certain point of value for people, and people were spending money on those things. So the NASDAQ did really well. And now still doing really well, right? Still up over 7% for the year. But we can also say that it's kind of have a little bit of a pullback. And that might have been just, either people think it would continue on that same run, or that we kind of had a little bit of some overvaluations, people paying a little bit too much for companies during some of those time periods. So maybe just a little bit of a correction there. S&P 500, again, still doing really well. And then international also doing really well. So again, times when the US dollar gets weak, international goods tend to do pretty good, so long as their currency stays strong. But we see that international markets do well while the dollar gets devalued. And that's because now it takes more of our dollars to buy international goods. So those are still doing really well. And then emerging markets, those are a lot of places where we see commodities in our portfolio. So things like copper and gold, all of those kind of tend to reflect themselves and have a high correlation with the emerging market portfolio. The other thing that's very interesting, right, is bonds. So we see corporate bonds, government treasury bonds, short-term corporate bonds, and then world bonds are negative for the year. And so what we like to point out is stocks and bonds tend to have an inverse relationship, meaning when stocks do really well, bonds tend to go down a little bit. And the reason is because people run to bonds for a safer asset during times like the recession. So bonds didn't lose as much as stocks last year in the 2020 coronavirus recession. So people tend to pour money into bonds. Well, now when the market does really well, people tend to buy stocks. So they sell their bonds and they buy stocks to try and catch up some of that upswing. So we see bonds tend to have an inverse relationship with stocks. That is a part of why bonds are going down a little bit, but that's okay, right? Because that's why the diversification of the portfolio is so important. Is if your money's in all stocks, then you would have lost 38%, last March when the market was crazy. But if you have that diversification with bonds and stocks in there, you have a much smoother roller coaster along the way. Additionally, one of the ways that the Fed combats inflation is to raise interest rates. So when interest rates rise, bond prices go down. Okay, so that's another slide we have in here. This is kind of some master's degree stuff and some finance nerd stuff that I really enjoy. But interest rates rise, bond prices fall. Why does that happen? Well, because if I'm a company or I'm an investor and I've bought a company's bond and interest rates are really low, so they are able to raise debt and sell some debt for some bonds at 3%. Well, as interest rates rise, as an investor, I'm going to say, well, I can go get another bond that pays more than 3% now that interest rates have risen. So I'm going to sell my 3% bond and I'm going to buy, say, a 4.5% bond. So when I sell those bonds, that's going to lower the price of bonds. So not only do stocks and bonds tend to have an inverse relationship, but interest rates and bonds also have an inverse relationship. So one of the reasons that bonds are not doing well so far year to date. So does that mean we should abandon bonds and we should abandon some of these asset classes? No. And the reason is because we don't know how high inflation will get. We don't know if it will continue on this pace. We don't know if the Fed's going to continue to raise the interest rates, how all that will play out. And so we're not going to try and time it or gamble. We're going to say, we're in the right portfolio to match your comfort for risk. If stocks get out of alignment because they do so well and bonds fall, then we'll sell the stocks while they're high, we'll buy the bonds while they're low, and we'll rebalance the portfolio for you. And so that's kind of how we help clients make sure they're in all the right asset classes so they get the return that they should expect, and then keep the portfolio aligned with their risk tolerance so that they can get that long-term expected return.
Yeah, Sean, I know just kind of a general question that comes up when we're talking performance and going in depth into this with our clients is, well, if bonds are doing so poorly or negatively for the year, why are they in my portfolio? And just kind of to emphasize, it's all about your risk score, right? So we invest in bonds, not for the return, but more so to reduce the risk in your portfolio. And everyone's is a bit different. So don't go running and thinking, oh, I need to put bonds in my portfolio to be diversified. It's really specific to what your goals are and what your risk score is. But, if Sean and I wanted to get a return, we wouldn't necessarily invest in bonds. We would just put that into stocks. And so the reason why bonds are in the portfolio is to reduce the risk. So just a key thing to think about if you're looking at your own portfolio, because I know we do have some people outside of our clients on here today.
Yeah, and I think it's very important too when people, see like the year to date and bonds are down. It's always interesting to me because people know that they should buy things when they're low, sell things when they're high, but so much value that an advisor provides to the people that they partner with is a lot of the behavioral coaching, right? So you don't want to buy when things are high. So a lot of people now will go running to buy small value now that it's up, but it's like you're already late. And so we're not going to try to time the market because we don't know when the time period will end. And past performance is not indicative of future results. And so what we do know is if we look at this in a very, very short time period of the stock market, right? This is just a 5-month period of the stock market. If we go back and look over 100 years, we can see that the value of the bonds in the portfolio isn't to get a bunch of yield. It's to reduce the risk because bonds tend to have less risk, as Nora pointed out, than stocks. So we add the bonds in there to kind of tailor the risk in the portfolio so that people don't lose as much. In the end, right after a 10, 15, 20-year time period, then we're going to get the expected return that we should, and people can see kind of how all the different asset classes played a key part during a different time period over that long term.
Great. Thanks, Tom. So that's kind of the topics, hot topics, performance-wise, that we wanted to talk about today. For the clients that are on, if you have questions about your portfolio, reach out to us. One thing that we really pride ourselves on is we want to know where and why you're invested, because we believe if you stay invested, you'll maximize your wealth. And so if you have any questions, reach out to us. We will see you in the beginning of July. So have a wonderful 4th of July weekend. Enjoy, hopefully, the nicer weather. I know I was just back visiting Cleveland for a little bit over the Memorial weekend, and I forgot my winter clothes. So hopefully the weather's nice where you're at, and we will talk to you all in July.
Thanks.